Well, hi everyone, and welcome to Buffett and Beyond Research Stock of the Week, and we're going over AutoZone. And folks, this is a great defensive stock, but it's also a great growth stock. It's very, very hard to get both in the same stock. And this is for September 27, 2025, and this stock is up when the market is down, as we're going to look at 2022, along with the past 1 year and past 5 years. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Okay, AutoZone, what's it do? Well, it's the leading retailer and distributor of automotive replacement parts and accessories in the Americas and the United States. And the company operates 6,432 stores in the U.S., including Puerto Rico and St. Thomas, 794 stores in Mexico, where it seems to be increasing number of stores quite a bit, and also Brazil, 127 stores in Brazil. It also conducts sales through its various websites, including alldata.com and alldata.com. DIY.com, oh boy, employs about 126,000 people. So it's still a growing company, folks, even though it's been around a very long time. And let's look at the 5-year averages. And we want to look at the clean surplus return on equity. And think of these numbers as if a bank account. Do you want to put your money in a bank account that's getting you 13.5% or one that's getting you 17.1%? So that's a good way to look at the clean surplus return on equity. And remember, the clean surplus return on equity is totally different than the traditional accounting return on equity. Now, net income is about a little bit below the average stock. Again, AutoZone is in green, the average stock is in blue. So the net income growth, little bit less than the average stock. But when it comes to revenue, the revenue growth is almost twice as much as the average stock. So it's got to bring more of this down to the bottom line, and that's the only thing we're worried about. However, there's some other good-looking parts of this stock here, folks, and let's take a look. We look at the clean surplus return on equity, and we can see that it has fallen. And it may be because there's a lot of competition in this field, but AutoZone really is at the top of the other companies, as we're going to see in a minute. And we don't care for this clean surplus return on equity going down. What does this mean? It means that the earnings are still growing. So the net income, the clean surplus earnings, the earnings are still growing, but they're growing at a decreasing rate. So back here, they were growing at a 19% rate, and then they're falling down to 14% or so. Retention rate is 100%. That means they're taking all the money they're making, putting it back into the company in order to grow. And when we look at the revenue growth over here, and the net income growth, we just looked at them in the prior chart, and you can see net income growth is a little below average, but revenue growth is almost twice as much as the average stock. Then with this chart, we look at years to pay debt, and that's Buffett's rule of thumb. And Buffett says if a company takes all the money it's making, how many years will it take to pay off its debt? His rule of thumb is 5 years or less. Ours is around 3 years or less. So this stock is sitting right there on the edge. And again, it doesn't pay a dividend because it's taken all the money it makes to put it back into itself in order to grow. And it's growing in Mexico, and it's growing in Brazil, still growing in the United States also. Now let's look at a 1-year chart and see how the price has done. Black line is the S&P 500, and the S&P 500 is doing pretty good over this past 1 year. But AutoZone is way up here. AutoZone is more than twice as much as the average stock, or the S&P 500 down here. So it's growing twice as much. Now let's look at the 5-year. The 5 years, well, it's up 266%, while the market, the S&P, is up about a little over 100%, 103% to be exact. So it's more than twice as much as the average stock in the S&P 500. But I want to show you something back here. This area in here is 2022. The stock market, the S&P 500, was down 19.6%. the Nasdaq was down 34%. So we had a tough year in 2022. It was never termed a recession, but boy, it looked like a recession, and the market reacted to it being like a recession. So again, the best market was down just 19%, 19.6%, while the Nasdaq, which has the tech stocks and the semiconductor stocks and the Amazons and some of those stocks, down 34%. But what did AutoZone do? AutoZone was up about 40% during that time. So yeah, with the S&P down 19.6% and the Nasdaq down 34%, this stock was up about 40%. So that's pretty good, folks. And that's what we like in a stock, to see the growth that is better than the average stock. Because remember, out there, 96% of professional money managers who manage the publicly traded mutual funds cannot outperform this black line down here. Over any 10-year period, 96% of those professional money managers cannot outperform this line back here. So when we look at AutoZone, we see not only is it outperforming by more than twice as much the 96% of those money managers, but when it was called on to be defensive, it was a very defensive stock. Now, why is it a defensive stock? Because when a recession starts to hit, or people fear a recession, it doesn't have to be a recession, but when they fear a recession, they will hold on to new purchases of new cars, and they will get their old car fixed. And this stock, AutoZone, is in the auto parts business. And so when the garage down the street that only has one or two people working in it, they need a spare part, they call up AutoZone, and AutoZone delivers it to them. So when you bring your car there, you don't have to leave it there for a week. They just call up, get the part they need, have it delivered, and your car's ready that afternoon. So that's the kind of service that they do. And we like this area right in here because it's a defensive stock. It's also a growth stock. These are the kind of stocks you want in your portfolio. And let us look at the other stock that we do have in our portfolio, and that's O'Reilly Auto Parts. Now again, black line S&P 500, blue line is AutoZone. This red line in here, this is O'Reilly, and O'Reilly is in our portfolio because look what O'Reilly did in 2002. Here we go. It rose right along with AutoZone. So yeah, both of these stocks are good growth defensive stocks, and we may be putting AutoZone in our dividend growth and income portfolio. O'Reilly is already in our growth portfolio and our dividend growth and income portfolio. So yeah, we like both of these stocks, folks. Look how they are performing. So, folks, we had a week this week that was up and down and all around. So go out and forget about the market. Go for a walk on the beach, walk on the golf course, go for a walk down the city block, walk around the block, be with your family, be with your loved ones, have Sunday dinner. Most of all, stay safe, and we'll see you right back here in a couple of days.